If you'd like to learn about Stan Weinstein's trading methodology, including his stage analysis for when to go long and when to go short, this is the video for you. One of the things that I love about Stan Weinstein's book, Secrets for Profiting in Bull or Bear Markets, is the fact that he engages the reader with quizzes. So that's what I've tried to do with this presentation, to try and engage you with quizzes, with interactions between us. So instead of me just talking to you, there's going to be parts where I'm going to ask you to play along. I'm going to ask you questions. Which chart is more bullish? Which chart is more bearish? So hopefully you get a lot out of this video. You learn a lot from it too. MarketSmith are the sponsor. You're going to see some of their charts throughout this presentation to help illustrate some points. If you're interested in a discounted MarketSmith trial, there is a link in the comment section below. And where I would like to start this video is with a quiz. Now we're going to come back to this quiz at the end of the video as well. So I've got two different questions to show you here. I'm going to leave the answer unanswered and we're going to answer it at the end, because that will be the litmus test for if I've really helped you to understand Stan Weinstein's methodology. So which chart is more bullish? Is it the one on the left here, or is it the one on the right? We're going to come back to this later on in the video, and there we'll have a really good conversation about it. Then another question, which chart is more bearish? Is it the one on the left, or is it the one on the right? Again, we're going to answer this at the end of the video, and hopefully you have a really thorough understanding of Stan Weinstein's methodology. So let's start with Stan's philosophy. It's really important to understand, how did Stan Weinstein think? How does he continue to think as well? So what I love is the directness in the book as well. So Stan goes against conventional thinking early in his book. Page 1, sentence 1. This is the beginning of the book. Buy low, sell high. That's the shortcut to a fortune, right? Wrong. Buy low, sell high is a cliche, not a blueprint for action. It blinds investors to the professional's approach of buying high and selling higher, which I'll teach you to do consistently. That is what this video is designed to help you with as well. Learn Stan's methodology. For over 25 years, I have been consistent in my approach and discipline. Discipline is really, really, really important. This is so very important. Don't be a fundamentalist one week, a technician the next week, and don't follow indicator A 1 month and switch to indicator B the next. Find a good method, be disciplined and stick with it. Be absolutely disciplined and don't ever abandon a successful method because you think this time things are different. Discipline and consistency. You must learn that the market is a discounting mechanism and that stocks sell on future and not current fundamentals. I therefore use a technical approach that deciphers the market interpretation of all the current known news as well as future expectations. So Stan was very much focused on the charts. He was much more of a technician, would kind of discard a lot of fundamentals, which you're going to see as we progress. All technical analysis really consists of is a study of price and volume relationships in the context of stage analysis to gain an insight into future trends. So let's go into what on earth is stage analysis. So what is stage analysis and why the technical approach? Well, the tape tells all was Stan's kind of motto. It was at the top of every PTR, professional tape reader report, that he used to write. So the tape tells all relevant information about a company's earnings, new products, management, and so forth. The fundamentals that is currently known and cared about is already incorporated in the price of its stock. It isn't that I don't care about an important piece of fundamental news, rather I learned a long time ago that you and I aren't going to find out about that juicy bit of news before it hits the broad tape, and by then it's too late. So what is Stan actually saying there, especially this kind of juicy bit of news? What he's saying is you're probably going to be one of the last people to hear about it. The bigger boys, the bigger girls, the institutions, the larger operators in the market, they already know it, they already have acted upon it. So what he's basically saying is any bit of fundamental information that you could possibly find out, it's already been discounted in the price. It's already been acted upon by those much more informed than you. So in short, Stan is saying everything you need to know is on the tape, i.e. the chart, both in terms of the company fundamentals and from a trade management technical standpoint for creating favorable reward to risk trades. Only price pays. So on the next chart, we're going to be going deep down into stage analysis and the 4 stages. So what on earth is stage analysis? Well, this is the backbone of Stan Weinstein's methodology, and he developed it by studying the action of the market, studying the action of individual groups, of individual stocks. This is how he came up with it, and what he could see is, well, these indexes, these groups, these stocks, they move in these cycles. So hence stage 1, stage 2, stage 3, and stage 4. So stage 1 is the basing stage, stage 2 is the uptrend, stage 3 is the distributional top, and stage 4 is in the downtrend. Don't worry, we're going to really break this down, and by the end of this video, this chart here is going to be second nature to you. I appreciate at the minute it may be like, whoa, what does all this mean? What are all these lines? What are these trading areas? What is support? What is resistance? Don't worry, by the end of the video, you're going to get it all. So the 30 week, Stan used the 30 week, which is indicated by this purple line here, moving average. He thought that that was the best moving average for long-term investors. So as you're going to see, as we start progressing through the ideal buy points and sell rules, Stan refers to two types of market players. He talks to investors, but he also talks to traders. So we'll be talking about the different rules for traders and investors. So the 30-week moving average, that is the 150-day moving average if you are on the daily chart. He then used the 10-week moving average, which is the 50-day for more so traders. So we'll talk about deciding whether you are more so an investor or a trader as we progress throughout this video. Let's just do some definitions of trading ranges, because you can see, well, we have a trading range here and we have a trading range here. One is going to be a stage 3 top, don't worry, that's all going to become clear later in the video. And down here, this is a stage 1 base. So a trading range, price stays within clear upper and lower boundaries. What is a downtrend? So you see here, this is a downtrend, which would be stage 4. A downtrend is when price is making lower highs and lower lows. And what is an uptrend, which would be stage 2. Well, an uptrend is higher highs and higher lows, so it all refers back to the action that you are seeing on the charts. So let's now really break this down. So I've called this section Stage Analysis Made Easy. This is an overview, and then I'm going to give you a definition of each stage in Stan's own words. So here you go, we have our 30-week moving average. So you can see it's kind of sloping down here, then it flattens out, then it goes into this nice uptrend, flattens out, rolls over for stage 3, and then goes into this downtrend for stage 4, and then starts to flatten for this stage 1. So stage 1, stage 2, stage 3, stage 4, stage 1, stage 2, stage 3, stage 4. You following along? You get it? So stage 1, okay, is going to be down here, which we're going to look at on the next chart. So what on earth is stage 1? Well, stage 1, after stock XYZ has been declining for several months, it eventually will lose downside momentum and start to trend sideways. So you see how it's starting to trend sideways here. Price is moving within defined boundaries. There's an upper boundary and a lower boundary. That's what we're looking for, and you often see that the moving averages starts to flatten. What's actually taking place is that buyers and sellers, so supply and demand, are starting to move into equilibrium, whereas previously the sellers were far stronger in that stage 4 decline, which is why the stock had plummeted. So supply is overcoming demand. There's more supply coming to the market. Volume will usually lessen, dry up as a base forms. So from left to right of this stage 1 base, what Stan is saying is actually commonly you'll see the volume sloping down as well. But often volume will start to expand late in stage 1, even though price remains little change. This is an indication that dumping of the stock by disgruntled owners is no longer driving down the price. The buyers who are moving in to take the stock off their hands are demanding no significant price concession. This is a favorable indication. So what Stan's saying, late in a stage 1 base, you can actually start to see an increase coming back in the volume. So you want to see volume generally drying up and then potentially starting to increase as well. So stage 1 then moves into stage 2. You're following along. The ideal time to buy is when a stock is finally swinging out of its base, so stage 1 base, into this more dynamic stage, such as a breakout above the top of the resistance zone, and the 30-week moving average should occur on impressive volume. You're going to see as we go throughout this presentation, Stan puts great emphasis on the volume at key points on the chart, especially the breakouts. This is the start of the advancing stage 2 uptrend phase. At the breakout point, which is the perfect time to buy, so the breakout point here, don't worry, we've got some really detailed examples. This is an overview and we're going to be going down into the weeds, which is the perfect time to buy. The reported fundamentals will often be negative. Interesting. So what Stan is saying there is oftentimes as stocks are coming out of phase of stage 1 bases, when they start breaking out and beginning their stage to advance, actually the reported fundamentals can be very negative. I'll then skip forward and get ahead of myself a little bit. So as the stage 2 uptrend is coming in, therefore the company may have easy comp. So easy see year-over-year comparisons. So suddenly the earnings then, as the stage 2 really starts progressing, could be up 100%, 300%, 500%. You'd have huge earnings coming through, and then actually at the top of stage 2, it's quite common to see that there, when it tops at stage 2 into stage 3, is then when the reported fundamentals, so the earnings that have been coming out, are at their peak. Quite interesting there about psychology. Okay, large operators tend to be very contrarian in nature as to what retail traders are doing, certainly on the fundamental side. In stage 2, the 30-week moving average usually starts turning up shortly after the breakout. This situation becomes a buyer's dream, that should say, as each successive rally peak is higher than the last. In addition, the lows on corrections are also progressively higher. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Basically the definition of an uptrend. This is important. As long as all these wild swings and shakeouts take place above the stock's rising 30-week moving average, don't worry. Everything is proceeding to schedule for a big profit. So what Stan is basically saying is, as long as the stock is in stage 2, as long as there's higher highs and higher lows and the stock's trending above its 30-week moving average, which is rising, chill out. Relax. Let's go into what stage 3 is. So stage 3, the upward advance starts to lose momentum and starts to trend sideways. So see how our price here, dynamic stage 2 uptrend, and now price is showing an inability to make those higher highs. It's starting to go sideways and move into a trading range. So we have clear upper boundaries and lower boundaries. What's going on beneath the surface is that buyers and sellers are once again about equal in strength. So there's not enough buying power, there's not enough buyers there to continue pushing it up and soaking up the supply on the pullbacks to form those higher lows and then pushing it up in the higher highs. So there's an equilibrium starting to form here between supply and demand. Volume is usually heavy in stage 3 and the moves are sharp and choppy, known as churning. The heavy volume on the part of the buyers who are excited by the improving fundamentals, remember what I just said, improving fundamentals or the story, is met with equal measure by aggressive selling by people who bought at considerably lower prices back here in stage 1 and early stage 2. The 30-week moving averages loses its upward slope and starts to flatten. The stock will now tiptoe below and above the moving average on declines and rallies. So it's just kind of tiptoeing, and Stan would stay here, but up and down, kind of chopping around the key moving average if you like. Now, what is stage 4? Well, stage 4, so this part here, this is after our stage 3 top. After moving back and forth in a neutral trading range, a stock eventually breaks below the bottom of its support zone. So this would be taking out the lows here. We're going to talk about shorting. This is a very good time to look for shorting. A downside break into stage 4 doesn't need an increase in volume to be considered valid. Take the oath that you are never going to buy another stock in stage 4. Now, this is a little subtlety we'll talk about later on in the video. Stan loved to see, and it was a requirement for him, that on breakouts from stage 1 into stage 2 and then stage 2 continuation basis, he wanted to see volume coming through on the breakout. But when the stock was breaking down, stocks can fall of their own weight. So when he was looking to short, he didn't necessarily need that increase in volume he'd look for on the breakouts, because stocks can just fall of their own weight, and fearful sellers can drive prices down much quicker. Okay, so stocks invariably take the escalator up, so a bit slower, but the lift down. Okay, just something to remember. So on the next slide, we're going to be going into the ideal time to buy. So in Stan's own words, what is the ideal time to buy? Well, Stan's book is aimed at 2 types of market participants. So I know this page here is a little bit heavy on the text, but it's actually really important because it will help you decide, are you more of an investor? Are you more of a trader? And we're going to talk about investor and trader psyche a little bit later on. So Stan spoke to the investor and he also spoke to the trader. So the investor, your investing time frame is up to 12 months. Buy half of your intended position on the initial breakout, so of stage 1, and we're going to talk about that in a second, and the other half if the stock pulls back close to the breakout price and you like the post-breakout action. Don't worry, got loads of examples to be going through. Investors should do 80% of their buying from stage 1 breakouts and 20% from stage 2 continuation breakouts. Investors should concentrate their buying in those market areas breaking out of stage 1 base patterns. So that's about the investors and where the investors should be looking to buy. Now, what about the trader? Well, a trader is someone who wants to catch each significant 2 or 4 month move. If you are a trader and want to buy the stock, purchase your entire position on the breakout. So what Stan's saying for the investor is buy half of your intended position on the breakout and then another half on the pullback, more so 80% of the time from stage 1 base patterns. For traders, he's saying buy your entire position on the breakout, and traders should lean towards continuation moves in already existing stage 2 uptrends. And what Stan would actually say is traders should basically do the opposite of investors. 80% of their buys should be from stage 2 continuation type plays, with 20% from stage 1 breakout. So it's different. Hopefully this is starting to make you think a little bit. Are you more of an investor? Are you more of a trader? Much can depend on your psyche as well. So the summary, the very best situation for an investor is a stock that is in an early stage 2 breakout in a group with the exact same pattern. We're going to talk about the indexes, we're going to talk about groups, we're going to talk about individual stocks. For a trader, the ideal is a continuation pattern breakout within a dynamic group exhibiting the very same sort of pattern. So Stan would look for very strong stocks, but he would like to have the groups confirming that as well. So let's go through a couple of examples. Always remember, the bigger the base, the greater the upside potential. There's an old saying among technicians, the bigger the base, the bigger the move. The corollary being, the bigger the top, the bigger the drop. So this is kind of the law of cause and effect. Bigger causes, so bigger bases, tend to lead to bigger effects, both in terms of the stage 1 accumulation, but also the stage 3 top as well. If you see a really big stage 3 top, that can mean that the stock could be in for an almighty drop. So this is where we're going to get into a little quiz, and I've got some later on as well. As I said, I want to give you kind of a really good insight into Stan's methodology, but I want to try and make it engaging for you. So I've got some quizzes, some charts like this where I'm asking you, which is better, and we'll get on to some more in a minute. So this here is going to be for the investor. So this is the 30 week. Do you see how this is coming out of a stage 1 base here? And for the trader, this is coming out of a stage 2 continuation type pattern. So if we were saying which is better for the investor, well, according to Stan, it would be the stage 1 breakout. This is where investors should be doing 80% of their buying, and from stage 2 breakouts, 20% of their buying. Traders, on the other hand, 80% of their buying from stage 2 breakouts, continuation type pattern breakouts, and 20% from stage 1. So as we go through some quizzes a little bit later on, you'll start to see, well, is it better for potentially an investor? Is it potentially better for a trader? Let's see. Now, Stan talks about buy stop limit orders. So from now on, whenever you want to buy a stock on a breakout, use a buy stop order on a GTC, which is a good till cancelled basis. What on earth is a buy stop limit order? Let me take a minute to explain here. So let's say we have a stock, it's in stage 2. This is a strong stock, strong group, and the market is rocking and rolling as well. So price powers up here to $100, and then it starts building successive high lows. So we have one contraction to 90, we bounce back up to $100, then we pull back down. This is probably about, what's that, $97 or so. We bounce back up to 100, then we pull down here. So we'll call this 90, 94, $95, then we bounce to $100, then we pull back down to $97, and then the breakout comes through here. But how on earth do you buy it? What do you do? Well, I appreciate most of you are probably working as well. So Stan addresses this in his book. You don't need to be staring at the ticker tape or the screen all day. So here, this is where buy stop limit orders, which are the ones that I invariably use myself as well, because I just like them. So the buy stop would be here. Think of the buy stop as the trigger price. So the order is only going to go into the market if $100 in this instance is taken out. But hang on a minute, because price could jump $10, $20 above 100. So you thought you were going to buy it at $100. Now you're filled at $120 because the stock gapped 20%. How do we get around that? Well, this is where the buy stop limit, so the limit part, the limit is limiting how much you are willing to pay for any shares. So this is what Stan talks about in his book. Okay, a buy stop order on a good till cancel basis. So for this instance here, we could go, well, we want to buy it when price goes through $100, but we don't want to pay any more than $101 a share. This is very important for then thinking about the risk as well. So this is the limit area as I've set here. So let's say you're going to buy 1,000 shares of this stock with the buy stop at 100 and the limit at 101. So the maximum you are going to pay for any shares is $101, which is 1% above the pivot. That's really useful information because then you can plan out your trade management for how much risk you're going to have on the trade. So our buy stop is 100. Our limit is 101, 1% of the pivot, 1% above the pivot, this shaded green area, and then our stop loss is going to be placed at $97. So this is more so for a trader underneath the most recent swing low, the most recent contraction ran about $97. But Stan does mention in the book, and I'll come on to it later, put it underneath whole dollars and half dollars be underneath it. But our stop loss, if we get filled at $100, is going to be 3%. But if we got filled at $101, our stop loss is going to be 4%. So the buy stop limit order helps you determine how much risk you're going to have on a trade. We'll come on to risk management later. It's really, really important. Another thing is when not to buy. I want to make sure that you know what not to buy. A very common mistake is to buy when a stock breaks out above its base, even though it is still below its declining 30-week moving average. So for Stan, it's still in the definition of a downtrend. So he's saying don't buy breakouts in downtrends when the price is below the 30-week moving average. This is not a stock you want to purchase since it is not yet ready to start a sustainable advance. It's more likely a base forming in the context of a downtrend. So the stock is then going to fake out, break out, roll back over. In most cases, there will be a temporary rally for a few weeks, then the stock will falter. So you see here, the stock is in a downtrend. Why? It's making lower lows, lower high, lower lows, lower high. Then it starts going into this trading range where there's a clearly defined upper boundary and lower boundary, then there's a breakout. But what's the problem with it here? We're still below the 30-week moving average, the 150-day moving average, which is still sloping down. So what Stan is saying, avoid breakouts in downtrends. Have the market at your back. So on the next slide, we're going to be going into what to buy. What to buy. So now we are starting to get into it, and there's going to be a couple of slides with some quizzes on where I'm going to ask you some questions. What's a better breakout? So Stan had his forest to the trees approach. So Stan would actually start with the market. He would then look at the groups, and then he would look at the stock. So he would start higher and work his way down. He would want to know, what is the trend of the market? What are the leading groups? What stages are they in, and what stage is the market in? And what are the leading stocks and what stage are they in? So market, group, stock is how Stan approached it. You should work from the large question. How is the overall market? So what stage it is in? Down to the smaller component, which stock looks best to buy? In between these two extremes is the middle part of the equation, which group is acting best technically. So the process unfolds in the following manner. So now we're getting an insight into Stan's process, how he thought about things. What's the trend of the market? If it's negative, you'll want to do very little, if any, buying. Your probabilities of success are quite low when the market trend is going against you. Which few groups look the very best technically? The importance of this question can't be overemphasized since my studies have consistently shown that two equally bullish charts will perform far differently if one is from a bullish sector while the other breakout is from a bearish group. The favorable chart in the bullish group will often quickly advance 50 to 75%, while the equally bullish chart in a bearish group may struggle to a 5 to 10% gain. So what Stan's saying there is a significant component of a stock's advance is its group action. William O'Neill actually found that 50% of a stock's move is related to its sector and also its group as well. So really, really important. I think O'Neill found that 37% was related to the sector and 12% was related to the group. So about 50%, just under. Once you determine that the market trend is bullish and group A acts the very best technically, excuse some of the typos in this by the way, the final step in the process is to zero in on the one or two best individual stock chart patterns in that section. If you follow this three-step process, you will find yourself heavily invested in the best acting stocks when the market is powering ahead. That sounds good, doesn't it? And sitting on large cash reserves when the overall market trend turns bearish. That also sounds good, doesn't it? So here we go. Which is a better breakout environment to be trending in? So we're starting from a bit higher up here, okay? We're thinking about the index. Don't ever fight the trend of the overall market and group. So let's say you're looking at the market and you're thinking about potentially buying some breakouts. Which is going to be a better market environment for you to be trending in? Is it going to be the left chart over here, or is it going to be the right chart? Take a look, apply the stage analysis as well. So the index here, well, it's getting back above its 30-week moving average. It looks to have built this stage 1 base here. It's got a good stage 1 breakout, puts in a higher high, higher low, tests the pivot area, tests the moving average as well, and then is making another higher high. Does that look like we're potentially in a better environment relative to the right chart here? What are we seeing? Well, it looks like it's been in a powerful stage to advance, but now, and you're going to learn about this pattern a little bit later on, what pattern is this? Any of you know? Head and shoulders type pattern. Left shoulder, head, right shoulder, and then it's rolling down below the key moving averages, making a series of lower highs and lower lows into a stage 4 breakdown. So over here, this chart here on the left is a much better market environment to be trading in. The proverbial wind is in your sails. Let's have a look at this one. Which is stronger, the market or the group? So this is where, and we're going to talk a lot about relative strength. So technical action reveals leadership. We have the index here, which similar to the prior chart is coming out of a stage 1 base. But then Stan would say, okay, I want to know what stage, what does the index look like? What stage is it in? Is it early in stage 1? Is it just getting started in stage 2? Okay, interesting. Maybe it's in a stage 3 top, maybe it's in a stage 4 decline. But then we want to dial it in and go, okay, if the market environment is looking conducive to trading breakouts in, what are the strongest groups? Well, if you take a look here, solar, which one is stronger technically? Well, solar here is in a powerful stage 2 uptrend and just breaking out, and the 30-week moving average is rising nicely. So the group, solar, is much stronger technically than the index. So this is where we want to be then focused and dialed in on. Now, which is stronger, the market or the group here? Which group or which area would you rather be looking in? Well, if we look at the index here, it's coming out of a stage 1 base into stage 2. And if we look here, we've got oil and gas. So oil and gas, head and shoulders top for a stage 3, and then it's in a stage 4 breakdown. So you probably, in this instance here, don't want to be looking at oil and gas stocks that have just gone into a stage 4 breakdown. There's probably going to be much better areas of the market to be looking at. Say solar, for instance, if solar was looking like this. Now let's do another one. Which group is stronger? So it may also depend on whether you're an investor or a trader, which is why I put that section in earlier for you to be thinking about, am I more an investor, am I more of a trader, and which one you're orientated to. It's not necessarily this is better than that, it's just understanding yourself a little bit more. Every year there are a few groups that far outpace all others on both the upside and the downside. So what you'll invariably see at any one moment in time, there's around 3 to 5 groups that tend to be leading. So if we look here, we've got airlines on the left and we've got semiconductors on the right. Which is leading? Which is stronger? Well, it's semiconductors, isn't it? Why? Because airlines are coming out of this stage 1 into stage 2 very early, whereas semiconductors are already in a confirmed uptrend. They're above the 30-week, rising nicely. It's built a nice base here, building higher lows, tightening up, stage 2 breakout here. But as we said, a trader wants to do about 80% of their buying from stage 2 breakouts, whereas an investor wants to do about 80% of their buying from stage 1 breakouts. So this question is actually dependent on, are you an investor or are you a trader? Because that probably leads you to the answer of which group may be more favorable for you to be trading it. Next one. Which group is stronger? So here we have steel and here we have copper. And you may be thinking, that's just the identical chart. What do you want about? Well, here we go. If, this is a quote from Stan, if multiple groups have bullish charts, the one with several excellent stock chart patterns will turn out to be the A+ of the batch. So sometimes you can have 2 group charts, as we've got here. We've got steel and we've got copper, and they both look, for the purpose of this, identical, don't they? Powerful stage 2 breakouts, 30-week moving averages is 30-week moving average is rising. You've got these higher lows building, constructed base. Which one do we go for? And this is where Stan is saying, look at the individual stocks within these groups and decipher which has the best individual stock chart patterns. The group that has the best individual stock chart patterns will likely be the better group to be involved in. So if you look at the steel stocks, and let's just say there's 5 steel stocks, and you rate you actually rate the quality of the setups from 0 to 10 being fantastic, and you're like, they probably average like 5 out of 10, 6 out of 10, but you go across to the copper stocks, and let's say there's 5 again, and you're like, whoa, hang on a minute. There are several that look like 9 out of 10 setups, 8 and 8 out of 10 setups. The copper is probably going to be the better one to be going in. So which group is stronger here? Which one would you rather be involved in? And this is whether you're an investor or a trader as well. So zero in on the 1 or 2 groups that contain the most exciting upside potential with minimum downside risk over the next several months. It's crucial. So there's a cyclical nature to this as well, right? There's cycles. This is the kind of cycle of the stage analysis. Stage 1, stage 2, stage 3, stage 4. So as much as you may see that software has been in a stage 2 uptrend here, it's not going to stay in a stage 2 uptrend forever. It's not going to stay in a stage 3 distributional top with this head and shoulders type pattern that you're going to learn about forever. It's not going to stay in a stage 4 breakdown forever. So this is why it's about doing the research, doing the work, doing your due diligence and going, what looks most attractive right now? What are you seeing in the market? And again, it's gonna change. Not just because it's going into a stage 4 breakdown here. That's not to say in 2 weeks' time it's not reversed and suddenly it's back in a stage 2 uptrend. things change. The market is constantly changing, so you've got to adapt it. But right here, as we look at it, and this is a Bayesian way of thinking, so you update your decision-making process when new information becomes available. Really important. Be adaptable, be flexible, update your decision-making process, how you're interpreting things when new information becomes available. So we have solar over here breaking out of a large stage 1 base. And let's imagine it's good volume coming through here. It's reclaimed the 30-week moving average, but we have software breaking into stage 4. Which stocks for breakouts do you want to be looking at? Probably solar, right? Why? Because of the stage analysis. Which stocks do you want to be looking for shorts? Software, right? Why? It's breaking down into stage 4. Got a couple of others for you. So which is stronger, the group or stock? And we're going to get onto relative strength in a little bit, and this will all start making sense. You may have to watch this video a couple of times for it to really sink in. I appreciate there's a lot of information in this one. So we've got the semiconductor group over here, and let's imagine the semiconductor group is breaking out of stage 1. It's breaking out of stage 1, powering out here, and then we have semiconductor company XYZ. So we have the group here, and then we have the individual stock here. So ideally you want to look for stocks that are stronger than the group. So here we can see the semiconductor company XYZ is in a powerful stage 2 uptrend, builds this continuation base above its 30-week moving average and is breaking out. It's showing relative strength versus the group. This is good. You always want to look for the stocks that are stronger from a stage analysis perspective than the group. And then we can also look at which stock is stronger. So this is where, again, it may differ if you're a trader or an investor, but which stock is stronger? So we've got semiconductor company ABC, and then we've got semiconductor company XYZ. Which one technically is stronger? Well, we have one here, company ABC, breaking out of this stage 1 base, but we have company XYZ breaking out from this stage 2 base. So which one is stronger? Now this may somewhat depend on if you are a trader or an investor, but relative strength is very important. The market does not miss the best opportunities. So the market at this moment in time is telling you that company XYZ is much stronger. Why? Because it's much further in its stage 2 breakout. So XYZ, company XYZ is the leader, whereas company ABC is the laggard. Interesting point. So let's just give you an example here before we go into relative strength. So this is a chart from MarketSmith. Remember, there's that discounted trial in the comments below if you are interested in MarketSmith. So we can see here, this is actually apparel, shoes and retail manufacturing group chart at the time of filming this video in April of 2023. What do you notice the bottoming pattern is here? And you'll recognize this as we go along and you start to learn about head and shoulders, tops and bottoms. What do you notice? Left shoulder, head, right shoulder, and it's in a powerful stage 2 uptrend. And take a look at this RS line here, really powerful. And then here we've got ON. Now MarketSmith actually ranks these stocks by relative strength. This is RS and earnings per share as well. Then if we look over here, this is ON. So on shoes, I have a pair of shoes, I have a pair of their shoes, my wife has a pair of their shoes. We really like them. And when we then look here, well, this is interesting. We've got ON, so on, building this very large stage 1 base. Then it breaks out on earnings into stage 2. Look at all the volume coming through. It's got really good earnings coming through, triple digit earnings. It's got high sales coming through. It's got really good estimates with guidance up as well. So this is now in a powerful stage 2, where at the time of filming this, I'm looking for a continuation type base to form. So you have a strong group, and then you have a strong stock within the group as well with a really positive reaction to the earnings. So hopefully this there is giving you a really good kind of feel for things. And on the next section, we're going to be going into relative strength. What on earth is relative strength? I've been talking about it a couple of times so far. So let's get into Stan's definition of relative strength. If XYZ rises by 10% while the S&P 500 advances by 20%, XYZ is lagging badly even though it is moving higher. Not only isn't it a leader, but it obviously is being pulled reluctantly higher. Therefore, the probabilities are very high that when the overall market turns down, XYZ will get bombed. Conversely, if it drops by 10% while the market averages plummet 20%, then it is putting on a good show of relative strength. And once the market turns higher, this stock will likely lead the hit parade. So the basketball underneath water analogy, the market is holding it down if these stocks are building bases, but the RS line is turning up. Side note, I have a free relative strength line on TradingView. Search my name in TradingView indicators and you will find it. It's favorable that the RS line is trending higher. The probabilities favor an upside breakout from this neutral range, so this base, when you see an inferior When you see inferior action in the RS line compared to the price performance, don't ever buy that stock. So what Stan is saying is he wants to see stage 1 bases, stage 2 bases, but the relative strength line turning up. So the relative strength line preferably making higher highs, higher lows, higher highs, higher lows as the base is forming, because that is telling you that the stock is much stronger than the index. So let's do a couple of examples so you start to get an idea. So relative strength, we have company ABC on the left, and it's building a stage 2 continuation base, and here's the breakout, and you see how the 30-week is still moving. But we have company XYZ building the same base here, but see the difference. The difference is the relative strength line. With company XYZ, the relative strength line is turning up. With company ABC, the relative strength line is turning down. So Stan says, absolutely never buy a stock, no matter how good the other factors, if the RS line is in poor shape. So see how the RS line is in a downtrend here. It is underperforming the index. Even before the breakout, relative strength was trending higher, which was a positive sign. So Stan put great emphasis on relative strength and looking for the stocks outperforming the market. That tends to be where the institutions, the smarter institutions go. They go to where the relative strength is in the market. A few more examples. So relative strength. Which group do you want to be involved in? You've got Group A here and you've got Group B here. Which group do you want to be involved in? So the stock's RS line had better be putting on a decent show of relative strength or forget it. You could think of that as both the stock and also the group as well. So you want leading groups and leading stocks. How do you decipher whether they're leading or not? Well, you can pay attention to the relative strength line and what stage they are in relative to the index. So we can see here with Group A, it's powered up here, and look at the relative strength. The relative strength was great, and this is what I mean. It's cyclical as well. Relative strength in a group or a stock does not say strong forever. It eventually goes. So this is why kind of your analysis has to be on a daily or weekly basis. Bayesian mentality, update that decision-making process as new information becomes available. But then we start to see price losing its 30-week moving average, goes into this trading range here and starts rolling back over. So at this moment in time here, relative to this moment in time for Group B, which group do you want to be more involved in? Group B is powering out this stage 2 uptrend. Look at the RS line. This is where the strong stocks are going to be. Let's do another one here. Relative strength, company A, B, C, and then we've got company X, Y, Z. So this is my own quote, which I quite like actually. So relative strength is not, that sounded really big-headed, didn't it? Relative strength is not my opinion or your opinion. It's the opinion of the market. So this is what Stan was saying earlier on, okay? The tape tells all. Focus on the action of the tape. Focus on relative strength. The market does not miss the best opportunities, and the best opportunities are not what I say it is, it's not what you say it is, it's what the market says it is. You've probably heard the old saying, it's more important to make money than be right, okay? You don't have to be right, you just want to make money, which is probably why you're watching videos like this and trying to read Stan Weinstein's book and other books as well, okay? You don't need to be right, you want to make money. Making money is the objective, being right is not the objective. So if we look here, company ABC, what chart pattern is this? Head and shoulders top, left shoulder, head, right shoulder. Don't worry, you'll learn about that a little bit later on. So it's losing its 30-week moving average. Stage 4 breakdown here. Look at the deterioration in the relative strength line. Whereas company XYZ is in a stage 2 uptrend, builds a very constructive base, 30-week moving average, rising nicely. Look at this relative strength line. Fantastic. This is a much better stock to be long of, whereas company ABC is a much better stock to be short of. So let's go through a summary of what to buy. Let's make it really simple, and I made it really big and bold so it just stands out. Strong market trend in stage 2. Number 2, identify leading groups in stage 2. Number 3, buy leading stocks in stage 2 from leading groups. Great quote here by Stan. Don't try to be a whiz kid and attempt to find the one winner in a sick group. Don't try to prove you're a market genius. Let the so-called geniuses lose their money while you very simply find an A+ stock in an A+ group. Then just enjoy the ride and the big profits. So hopefully that there was a really good summary of thinking about what to buy and the type of things that you want to be looking for from a stage analysis and comparative analysis as well. This group versus this group, this stock versus this stock, the stock versus the index, the group versus the index, so on and so forth. In the next slide, we're going to be going into overhead resistance. Overhead resistance. So the less resistance, the better. What on earth does that mean, right? Well, let's start talking about it. Remember that support, once broken, later becomes resistance when the stock rallies back to that levels. My studies have shown that the older the resistance, the less potent it is. Whenever a breakout occurs with a stock moving into virgin territory, so 52-week highs, all-time highs kind of thing, this is the most bullish situation you can buy, because nobody, especially if it's all-time high territory, no one who owns a stock has a loss. No one is down on their position. Maybe a couple of day traders or scalpers or whatever, but the vast majority of holders, okay, have a profit. Fantastic. So what is overhead resistance? Well, let's go through our stage analysis here. So here, let's say that there is a stage 3 top here, okay, stage 3 top here, and then we go into a stage 4 decline, then into a stage 1 base. So if you had a stage 1 base that had this overhead resistance, okay, up here between 40 and 50, but you also had another stage 1 base breakout from the same level of about $25, but the resistance zone, the overhead supply, was not until, say, $70, $80, then that would be a better one. Why? Because the resistance is further away. So the stock, the share price, can go further for longer before it meets the overhead resistance and starts running into the trapped buyers. So you want to look for the stage 1 base breakouts. You want to look for where is the resistance. The importance of volume. So throughout the book, Stan puts significant emphasis on how important volume is at certain points. So let's get into Stan's quote. Volume confirmation on a breakout is crucial. Volume is a gauge of how powerful the buyers are. Stocks can fall of their own weight, but to advance it takes plenty of buying power. Volume should pick up significantly on the breakout. If it doesn't, the probabilities are at the very best, you've got a mediocre winner on your hands that will advance only a few points. Never trust a breakout that isn't accompanied by a significant increase in volume. Look for the following: either a 1-week volume spike that is at least twice the average volume of the past month, preferably higher, so the higher the volume, the better on the breakouts in essence, or a build up over the past 3 to 4 weeks that is at least twice the average volume of the past several weeks, coupled with at least some increase on the breakout week. If you are using daily charts instead of weekly graphs, look for a volume increase on the breakout day of better than twice the average volume of the prior week. So here we've got company ABC, we're in a stage 2 uptrend. Here's the breakout coming through, and what I've tried to indicate here is see how the volume dries up from left to right in the base, and then on the breakout and thereafter you get a very big relative increase in volume. So there's no point comparing the volume of company ABC to Google or Netflix or Microsoft or Amazon, okay? It's all relative. So here we can see a relative increase in volume that is significant. Side note as well, one of my own experiences of trading many breakouts and studying tens of thousands of them is you see this volume bar here. What I've tried to indicate is oftentimes you will see volume really dry up in the week before or the days before the breakout, and you'll get a really tight bar coming through. So volume dry up before the breakout, then big volume on the breakout is really, really good to see. So let's do a couple here. Which is a better breakout? So you've got company ABC again, and then we've got company XYZ. Both of them are breaking out from stage 2 breakouts, and I put this purple line here. Now let's just imagine that this purple line is showing us the 30-day average volume. That's what I use on the daily chart and the weekly chart. I use the 30 bar whatever time frame that I'm trading on. So this here is going to be our average. So we can see in the days before, let's imagine that this is, well, let's stay on the weekly chart. In the weeks before the breakout, we can see a dry up in volume, telling us there isn't much selling pressure, there isn't much supply coming to the market. That is for company ABC and also company XYZ. But XYZ, well, the volume on the breakout is hum-hum. It's so-so, isn't it? It's showing us, remember what Stan said, volume is a gauge of how powerful the buyers are. Which chart is showing you more powerful buyers? Is it company XYZ or is it company ABC? It's company ABC, isn't it? Look at the volume coming through. It's at least double, if not maybe 2 times, 2.5 times the 30 bar average that we're using for this purple line here. This is a much better breakout. It's confirming the breakout, if you like. So on the next slide, we're going to be going into some head and shoulders bottoming type patterns. So one of Stan's favorite bottoming type patterns, if not the favorite bottoming type pattern, was the head and shoulders bottom pattern. So let's start talking about it, because we're going to be talking about head and shoulders bottoming type patterns and head and shoulders tops, which are actually Stan's favorite shorts, as we get a little bit later on. So what on earth is a head and shoulders bottoming type pattern? Well, you're looking for a stock in a stage 4 downtrend. So below its 30-week moving average like this, and we can see lower low, lower high, lower low, lower high, and then we make a lower low here, and then we power up, then we put in a higher low, and then we start breaking out, and the moving average starts flattening. So this is then looking for the left shoulder, okay, rally, the head, which then makes a lower low relative to the left shoulder. The head will invariably power up to around about the high of the left shoulder area, as I've shown here. And then the right shoulder, here's the important bit, okay? The right shoulder makes a higher low, so a structural higher low relative to the head, okay? You may then get another higher low and another higher low after the right shoulder, but you're looking for a lower low, okay, then another lower low, and then a higher low. So lower low, higher low. And the higher low is potentially indicating a change of character, that more buyers are stepping up. And then you can have these stage 1 base breakouts. And don't worry, on the next slide, I've got some real life examples. Another subtlety to be looking for, imagine if this is a group, okay? The RS line can actually start turning up. So you could see the RS line that's been in a downtrend bottom around the head and then start trending up. That's a really good sign. Remember when we spoke about relative strength earlier, relative strength turning up into a breakout? Really, really good. So let's go through a couple of recent examples. So here you go. This is SMH. This is a semiconductor ETF. And at the time of filming, this is April of 2023. You can see last year and into this year, the head and shoulders bottoming type patterns for semiconductor ETF, SMH, IGV, which is a software ETF, and then NVIDIA as well. Look at these head and shoulders bottoming type patterns. Left shoulder, and then the head makes a lower low. And then you see the right shoulder here makes a higher low. And take a look at this RS line as well. These blue line, focus on the blue line. See how it's turning up. Interesting. IGV, software ETF. Left shoulder, head lower low, right shoulder, higher low. Look how the RS line is turning up. NVIDIA, left shoulder, head lower low, right shoulder, higher low. Look how the RS line is turning up. So what I like doing is, certainly in kind of the context of a bear market, as we've been in for the last 2 years now, over 2 years, especially for growth stocks, is if you start seeing the groups or the sector ETFs, such as SMH for semiconductors, IGV for software, if they start building these head and shoulders bottoming type patterns, there's probably some strong individual stocks in there, isn't there? Interesting, right? So if the index sector and or group charts are building stage 1 head and shoulders bottoming patterns, it's likely individual related stocks are building stage 1 bottoming bases, and leaders could be building stage 2 continuation bases. Interesting, right? So in the next slide, we're going to be going into Stan's don't commandments. What are Stan Weinstein's don't commandments? Let's go into it. There's 9 of them. Don't buy when the overall market trend is bearish. Don't buy a stock in a negative group. Don't buy a stock below its 30-week moving average. Don't buy a stock that has a declining 30-week moving average, even if the stock is above the moving average. No matter how bullish a stock is, don't buy it too late in an advance when it is far above the ideal entry point. Don't buy a stock that has poor volume characteristics on the breakout. If you bought it because you had a buy stop order in, sell it quickly. Don't buy a stock showing poor relative strength. Don't buy a stock that has heavy nearby overhead resistance. Remember that overhead resistance slide? Don't guess a bottom. What looks like a bargain can turn out to be a very expensive stage 4 disaster. We've all been there, we've all done it, haven't we? Instead, buy on breakouts above resistance. How many stocks to own in your portfolio is probably a question you're wondering. Let's see what Stan says about it. What is the right number of stocks to hold in my portfolio? The answer? There is no single magic number. I know that 1 or 2 stocks is far too dangerous in allocation of capital. I also believe that 40 to 50 stocks are far too many issues to keep track of. Okay, if you've got 40, 50 stocks in your portfolio, to try and make high quality decisions on 40 to 50 stocks is very, very difficult. For a small portfolio that's investing a modest amount, 10 to 25k, I'd diversify into no more than 5 or 6 stocks. But as you move up the ladder into 6-figure or higher portfolios, 10 to 20 stocks are the most that I'd invest in at any one time. Also, use approximately equal dollar amounts when constructing your portfolio. Don't put all your eggs in one basket, but don't go to the other extreme of using too many baskets. Don't do all of your buying from just one group. If 3 or 4 sectors exhibit great technical action, buy stage 2 breakouts from all of them rather from only group A. So if you read Stan's book, you would have read the part on the triple confirmation pattern, which sounds very sexy. So I'm going to tell you, what are the 3 things? So assuming all other criteria has been met, stock is in an uptrend above the 30-week moving average. Number 1, volume signal. The market champs almost always have substantially larger volume on the breakout than during any point in the stage 1 base area. We want to see volume of even more than twice the average trading at the past 4 weeks on the breakout. This signal indicates a tremendous interest in the stock. So a gauge, remember, volume is a gauge of how powerful the buyers are, as well as additional future demand. Impressive volume is the key ingredient to a super winner. Number 2, relative strength is a very important tool to use in distinguishing good from great buys. As a stage 2 breakout occurs, the RS line should be more decisive, should move decisively into positive territory. Strong uptrend, potentially 52-week highs on the RS line. Remember, TradingView, you can get my free RS line tool for that. Big move before the stock breaks out is number 3. So Stan's looking for a big move before the stock breaks out. If a stock has wide swings while still in its stage 1 base pattern, then it's far more likely to be a ball of fire once it breaks out. Just as a high jumper gets into a crouch before taking off upward, a stock that first dips, that should say, then gets up a good head of steam will be far more powerful once it leaves the starting gate. As a rule of thumb, stocks that have risen some 40 to 50% or more before breaking out do the best in the months ahead. So that there is the triple confirmation pattern. Then we're going to be going into, on the next slide, when to sell. So this section is going to be on when to sell. When do you sell your long positions? And I actually just want to start on Stan on Psyche. So this is the difference between investors and traders that we've been talking about through this presentation. Whereas most investors are more conservative by nature and like to keep their lives relaxed and calm, traders are more inclined to live on the edge. They enjoy the thrill of battle and the competitive tensions that come with making decisions on the firing line. Give some thought to understanding the kind of person you are and which approach you'd be comfortable with. So are you more of an investor? Are you more of a trader? Let's get into it. The sell decision is crucial if you are going to really win big in the market. Unfortunately, few market players ever master this important step. Instead, market players wrongly believe that you can't go broke taking a profit. The truth is that in the long run, you need to capture these giant advances to offset the losses. So Stan was really an intermediate term trend follower. By doing this, you'll have big net profits left over. The problem is that when an investor or trader often sells for no other reason than they're feeling that the stock is too high. So Stan's don'ts for selling. Don't base your selling decision on tax considerations. Don't base your selling decision on how much the stock is yielding. Don't hold on to a stock because the price earnings, so the PE ratio, is low. Don't sell a stock simply because the PE ratio is too high. Don't average down in a negative situation. Losers average losers, as Jesse Livermore said. Don't refuse to sell because the overall market trend is bullish. Don't wait for the next rally to sell. Don't hold on to a stock simply because it is of high quality. So let's get into it. When to sell for investors. These are Stan's own words. Never hold any position without a protective sell stop. That's true for traders as well. Never enter your order to buy until after you've calculated exactly where your protective stop should be. So we're going to go into the risk management section a little bit later on, but you can see the emphasis Stan is putting on risk management here. Okay, these first 2 points. Protective sell stops. Think about where you're getting out before you are getting in. Increased volatility is a two-edged sword. On the positive side, it gives us a chance to make money even faster. The downside is that when a reversal occurs, your stock can move from stage 2 to stage 3 far more quickly. When you set your initial stop, pay less attention to the moving average and more to the prior correction. The stop should be placed right below the significant floor of support. If the sell stop should be placed right above a round number, okay, put it just below it, that should say. Set it just underneath the round number. Apology for some of the typos in this. Psychology plays a very big part in market moves, and this is another example. So let's say you were going to buy a breakout at 105 and you were going to put your stop loss at $100. What Stan is saying is put it at $99.95. Don't put it bang on 100 because markets tend to move to round numbers. When to sell for investors. So this chart here, a little bit complicated. Let's start breaking it down. So I'm going to read you these quotes here, and then we'll get into it. Well, this one's a quote. This is what I'm saying over here. As long as the stock is above its rising 30-week moving average and the moving average is rising in stage 2 fashion, be sure to give it plenty of room to gyrate. This is for investors, remember. We'll come on to traders a little bit later. So let's stay here. we're gonna break this one down. Okay, this is probably going to be the most complicated slide within the presentation, so stay with me here. It'll make sense by the end. Maybe have to watch it two or three times for it to sink in. So let's say you're an investor. Okay, you identify this stage 1 base here. You got the moving average, it's starting to turn up, big volume coming through, so you buy the stage 1 breakout here at $51, and what I'm saying here is stop 1. So you're putting your stop loss here. So let's just say you're buying it at 51 and you're putting it underneath the most recent swing low, which in this instance here is going to be about $40. Remember what Stan said about round numbers. So let's say here that you put it at $39.95 or something, okay, underneath this round number here. So the breakout is here, you buy it here, and then you put your stop loss here. What Stan then basically says, just to give you a gist before I start explaining it, Stan is basically looking for the stage 2 and the rising 30-week moving average, but for price to be putting in higher highs and higher lows, higher highs, higher lows. So what Stan is then saying is when price makes a higher high and then a higher low, once price then goes above the prior higher high, that's when he's moving his stop loss up to the higher low. Have I confused you? Let me show you. However, on the first breakout, it's slightly different. So what you're expecting after a breakout is for the stock to break out and then pull back down and test around the breakout level. That happens more times than not. And certainly if you've got, say, the 30-week moving average or other significant moving averages, it can pull back down, test, and then you're looking for the reverse. So the time to move your stop from number 1 to number 2 would be as price starts approaching this point A here. So then it's making a higher high. So that's when you're moving your stop loss up. So it starts powering out. You get B, which is a higher high relative to A, and then you get higher lows, and then as price is taking out point B here, so see how it's breaking out, actually builds in the context of stage 2, a stage 2 continuation base. As it's then taking out here, that's when you adjust your stop loss from 2 to 3. So you're giving it, remember, plenty of room to gyrate. This is a little bit different for investors relative to traders. Then price makes a higher high at point C, pulls down, and then as it's taking out, as price then takes out the high at point C, you're then moving your stop from point 3 to point 4. Okay, see how you're bringing it up. So as the stop makes a higher high, higher low, and then takes out the higher high, that's when you're moving your stop loss up below the higher low, so the final contraction. Hopefully that's making sense there. Then at point D, okay, price makes a higher high relative to C, then it pulls down here. As price is then approaching point D, that's when you can move your stop loss from 0.4 to 0.5, okay, because price is doing it, but then it starts rolling over, and then as it undercuts this level, you would be stopped out. So Stan's stop loss strategy is trying to keep you involved during stage 2 and out before stage 4, and usually as kind of stage 3 topping is happening, with favorable reward to risk ratios. Very important, favorable reward to risk ratios. Look out for flattening moving averages along stage 2 uptrends as they indicate stage 3 has begun. So what I'm basically saying there, that's not a typo, but as stage 3 or as stage 2 kind of it actually kind of ends, kind of maybe you can get a climax run as well, but my point here is as stage 2 starts ending, you'll often see that moving average just starts rolling over like this. So flattening moving averages is something to be looking out for, and you'll see price stop making higher highs, and then you'll start getting lower highs and lower lows, indicating potentially the end of a trend, but in the context of the market cycle as well. So that there is when to sell for investors. When do we sell for traders? Now bear with me here, we are then going to go on to this slide where I'm going to talk you through it, but we need to give you kind of the proverbial meat on the bone. So these rules for traders are a little less rigid than for investors because you've got to be ready to turn on a dime, but there is still definitive guidelines. Consider taking some fast profits if your stock skyrockets in a hurry and becomes overextended, very overextended, if it moves far above its 30-week moving average. In such a case, it may make sense to lock in a huge gain on 1/3 to 1/2 of your position and ride the rest with a trailing investing sell stop. Traders must be much more aggressive than investors in their use of this sell stop tool. Investors ideally want to stay with a position as long as the stock is in stage 2. Traders, on the other hand, realize that time is money. They not only want to sidestep all significant declines, they want to take out of the stock, they want to get out of the stock if it is entering a neutral zone for several months. This makes sense because they can shift into a new stock that is ready to move into the exciting part of its cycle while the old situation simply zigs and zags. Therefore, a trader shouldn't wait for the 30-week moving average to be violated on a sell-off before selling. So what Stan's saying there is, the stock could either be entering a stage 3 top, or it could be entering a prolonged stage 2 basing type pattern. So the trader can then get out with some of the rules that we're going to be talking about, can get out, potentially then get into a different situation, and then maybe come back to this stock a little bit later on when it's ready to power out again. As a trader, you're looking for a faster but smaller upside move, so you should be willing to take a smaller initial loss if wrong. If the stock is going to be an A+ trade, it shouldn't drop significantly below the breakout point. So you should set the stop under the closest reaction low, or kind of a maximum of 5%, as you'll find out a little bit later on. But what Stan's saying there as well with this part here, as a trader, you're looking for a faster but smaller upside move, so you should be willing to take a smaller initial loss. What Stan's saying there is your stop loss kind of strategy, so where you're getting out, the percentage that you are willing to risk is a function of how much you are expected to gain. So therefore, if your expected gain is less, so for a trader would be less than an investor who's trying to sit for the really long moves, therefore you want to be risking less than, say, an investor does, okay? So your risk is a function of where you're targeting and achieving your average gain. Those breakouts that are going to be big winners in a hurry almost never pull back more than 4 to 6% below the breakout point. So if you can't find a nearby meaningful sell stop point, you can place it at 4 to 6% below the breakout level. However, make sure it's beneath a round number. Traders shouldn't pay attention to corrections of less than 7%. This is in the context of an uptrend. Only deal with more meaningful moves. A trader should never stay with a position if it breaks below the 30-week moving average by even a fraction. So if it comes down to the 30-week moving average, you can get out of it if you're a trader, is what Stan's saying. When to sell, so traders. So here we go. There's a stage 2 breakout, which traders are going to do around about 80% of their buying from stage 2 breakouts. So remember, it gets out here, then it pulls back down. So breakout, test, reversal. Breakout, test, reversal, breakout, test, reversal. That's usually how they unfold. Then what Stan's saying is what we do is when it comes back to point A here and starts looking like it's going to make a higher high, we raise the stop from point 1, say underneath this little contraction here, which may be around about 5% on this chart, let's say, okay, because the breakout's around about 60. So let's say we're placing our stop loss at 57-ish, something like that in here, okay? So breakout, test, reversal. Then when price is approaching point A here on this rally, we move our stop loss from point 1 to point 2, and then we get a higher high, so A to B, higher high, pulls down, higher low, that's good. And then as price is approaching point B here, so higher low, then the reversal, that's when we move our stop loss from point 2 to point 3, then C makes a higher high, and then it pulls down, does make a higher low in here, and then here, see how it starts approaching point C. So this is where we'd move our stop loss from 3 to 4 underneath this recent swing low, this higher low here, and then we'd be taken out here as well. We're also going to talk about trend lines for selling, which we're going to do on the next chart, but you may also experience that the stock, when it starts pulling back down and then making lower highs and lower lows, you got a deterioration in the relative strength. So when to sell, use of trend lines. So what Stan says here, if you want to move to an even higher level of sophistication and score larger gains, you should learn to use trend lines and incorporate them into your trading plan. A clear-cut trend line is one that connects at least 3 points. So really important here for trend lines, it has to connect 3 points, okay? Any trend line can connect 2 points because you could just draw from here to here. For a trend line to be significant, 3 points. So here you can see point 1, point 2, point 3. We've got 3 points. So what we have here is a stage 2 breakout, but what Stan's saying is when price then takes out this trend line here, this is when you can sell. So in the previous example, remember, we were selling down here. This is for the trader. We were selling here on a break below this low, but actually here we're actually selling up here, okay, using the trend line because the trend line is running through here. See this? So the exit would then be here on a violation, a breakdown of the trend line. So hopefully that was really useful for when to sell. Now we're going to go into the how to short section. How to sell short. So let's get into it. Stan's don'ts for selling short to begin with. Don't sell short because the PE is too high. Don't sell short because the stock has run up too much, whatever too much is. Don't sell short a sucker stock that everyone else agrees must crash, so kind of avoid herd mentality. Don't sell short a stock that trades thinly. Don't sell short a stage 2 stock. The starting point is to look for a stock that has had a substantial advance over the past year. Make sure your short sell candidate is in stage 3 with a flat moving average, or even better, a moving average that is starting to decline. Also, look for a stock that has trended sideways for several weeks. Moving sideways is a sign that a distributional top formation is unfolding. Finally, look for a clear-cut level at or preferably below the moving average that will signal the start of a stage 4 downtrend if violated. Don't worry, got a lot of charts to be explaining this. More golden nuggets on shorting from Stansberg. 1. The market trend is down. 2. The group is weak. 3. The stock has had a significant stage 2 advance. 4. The stock has a weak relative strength line in the weeks before shorting. 5. Volume isn't needed on a short stale like a breakout. Stocks can fall because of its own weight. 6. No buy nearby support. So remember we were talking about overhead resistance and looking at where the overhead resistance is. Okay, when we look for a stock to short, we want to kind of ensure that there is no nearby support, that the drop could be really, really significant. So let's get into it. So, when to sell? Traders should sell short their entire position on the breakdown. Okay, so that's going to be this point here. We're going to talk about this on the breakdown. Investors who want to keep their risk to a minimum should sell short only 1/2 of their proposed position on the initial breakdown here, and then short the other half on a pullback, so a rally back to that price level, which would be here. So let's start talking about it. Stan likes to see a significant stage 2 rally. What he's saying is, and I've got a couple of examples with a quiz, is you want to see a stock that's had a massive run, not one that's kind of been, it's gone up 20% in its stage 2 advance, one that's gone up 200% in its stage 2 advance, okay, 10 times the other one. Why? Because the drop could be much more significant back to that kind of stage 1 base the stock potentially built out earlier on in its stage cycle. So here the stock runs from $40 up to a high of $100, quasi head and shoulders type pattern here. I should have drawn the head a little bit higher, but see how you have this kind of left shoulder, then this head, and then you go and put in this lower high here, and then as you break down through the support level and you're below the 30-week moving average, which is beginning to roll over like this. But what Stan is saying here is a trader puts on their whole position here, where an investor puts on half their position and then half a position on the rally back to that level. So remember, on the breakouts, the trader buys their whole position on the breakout, whereas an investor buys half on the breakout, half on the pullback. Stan's applying the same logic here on the short side. You would also like to see a deterioration in the relative strength. So if this stock's made a huge stage 2 advance, it's then likely that as it starts rolling over in stage 3, you'll see the RS line deteriorating as well. Same kind of thinking for the stop loss placement is how Stan describes it. So our initial stop would be above the recent swing high up here. So point number 1, the stock breaks, it pulls back in, so it then rallies, so it rallies back up, and then as it starts breaking down here and taking out this, now it's making not higher highs where we're then moving our stop loss up below the below the higher lows. It's reversed now. So now when it's making a lower low, we're putting our stop loss to the lower high. Make sense? So at this point here, when we're taking out this low, that's when we're moving our stop loss from point 1 to point 2 in here. It breaks, puts in another lower high as it starts then taking it down and undercutting this low, so it's making another lower low. That's where we adjust the stop loss, so from 1 to 2 to 3 to 4 like this, to then eventually being stopped out down here, and then it builds out. That you should recognize this now. This is a stage 1 base, and then it breaks out over here. So then when this high is taken out, that is when you'd then be taken out of your stop loss. Now, using the 30-week moving average and being short for this long may be a little bit more challenging in current time, so maybe you're using the 10-week moving average as opposed to, say, the 30-week moving average. Something to think about there. When to sell short head and shoulders top. So now I'm going to teach you about the head and shoulders top. So we looked at the head and shoulders bottoming type pattern. Here it is, head and shoulders top, which was Stan's, from what I can interpret in the book, Stan's favorite pattern to look for a short sale. So the stock has had a big stage 2 advance. That's the kind of lead in here to a head and shoulders top. Stan wants to see a stock that's had a big advance in stage 2. So again, the stock has gone from 40 up here to a high of 100 where the head is. So with a head and shoulders topping pattern, you're looking for a left shoulder, a head, and then a right shoulder. So the left shoulder will be here. It then puts in a low here. The head is a higher high, so a higher high versus the left shoulder. So you've got a higher high versus the left shoulder. Sometimes you can see the low after the head make a lower low. Sometimes it makes a higher low relative to the low after the left shoulder. So you've got left shoulder, bounce, head, higher low. That's really important. So the head is a higher low relative to the left shoulder, pulls down, and then the right shoulder is a lower high. So important that the head is a higher low. Sorry, a higher high versus a lot of higher highs, higher lows, lower highs going on here. It's confusing me, probably confusing you. So the head makes a higher high versus the left shoulder, pulls down. Then the right shoulder is a lower high versus the head. So the head's a higher high, and then the right shoulder is a lower high, and then as price undercuts what's called the neckline, so here, can you see how this is a left shoulder, this is a head, then this is the right shoulder, then this here, this blue line is the neckline. So as price then breaks down through the neckline, this is where Stan would say the trader puts on their full position to go short, whereas the investor would go half here and then on a rally back to the neckline, and it may coincide and be a confluence with the moving average, which has started to roll over here, okay, before the initial short. As it rallies back in, that would be where the investor would put on the second half of their position. So head and shoulder top formations, especially when they come after a dynamic stage 2 advance, are among the most profitable short selling signals. Don't trust the formation if the heaviest volume appears on the right shoulder. So if you suddenly see a really large increase in volume, okay, over here on the right shoulder, potentially, okay, it could be a sign that actually there's a lot of accumulation going on and could be a short trap. So Stan would say over here on the right shoulder, you actually want to see less volume going on. So drying up relative to what you've seen prior in the base, so below, say, the 30 bar average, whether that's the weekly chart or the daily chart. And the relative strength may have been really strong, and then you'd like to see going into it, relative strength deteriorating, the group deteriorating as well. Now for the exit as well, we can also look at trend lines. So we looked at trend lines for the advance. We can now look at trend lines for the decline as well. So when to sell short, trend lines. So here we have the head and shoulders bottoming, head and shoulders top pattern, so big stage 2 advance going on here, above the 30-week moving average, we start rolling over. But what Stan's saying here is, as an exit rule, you could also be using a breakout above a downward sloping trend line. So if no valid trend line forms, the one that hits at least 3 points, remember trend line, 1 point here, pretty much 2 points, 3 points, we actually get nearly 4 points here. Okay, I would also quasi include this here, it's encapsulating the data really well, and we have at least 3 touches. Then simply use the trading buy stop technique that we looked at on the previous slides. When a clear-cut trend line does form, it certainly pays to utilize it. At least a portion of the short position should be covered when such a trend line is violated. So this point down here, see how price then starts moving back through that trend line there. That would then be a point to take off part or potentially all of the position. So now I've got a little quiz for you. So which chart is a better short? Is it chart number 1 or is it chart number 2? What do you think? Well, chart number 1 is what pattern? It's head and shoulders top, isn't it? Left shoulder here, see the left shoulder? Hopefully this really stuck out to you now. Learning something in these YouTube videos. See this? Left shoulder here, then you have the head here, then you have the right shoulder here, and then it's breaking down through the neckline. Relative to chart number 2, which looks to be a stock in a powerful stage 2 advance. So this here is a stage 2 breakout, whereas this would be a stage 3 topping type action breaking down into stage 4. So by breakouts in stage 2, short in stage 3 into stage 4. So number 1 is a much better short candidate. Now this point here, remember that I was talking about, well, I'll ask you first, which chart is a better short? Chart number 1 or chart number 2? And you may be going, well, both of them are head and shoulders tops. Exactly, I'm trying to confuse you. Which one's a better short though? Think about what we were talking about. Stan wanted to see a big stage 2 advance. Which stock's got a big stage 2 advance? Which one has further to fall? Chart number 1, isn't it? Okay, in this here, imagine that this stock here has gone from $10 to $100 or $120 up here, whereas this stock here has gone from $10 to $50. Which one's got further to fall? So that's why you want to look for the really big stage 2 advances, because they can have further to fall in their stage 4 declines. You've only got to go and look at charts of Zoom, Peloton, all of those stocks, those kind of real kind of COVID stocks, the leaders. Okay, the Zooms, the Pelotons of the world, you can see how high they went in their stage 2 advance, stage 3 tops, and then stage 4, they've just fallen an absolute mile. Many are down kind of 80%, 90% and greater. So this one over here is the better short candidate. Next slide, risk management. So Stan in his book emphasizes risk management. He really stresses the point. So this is a fantastic quote. How you deal with this fact of life, losing trades, will go a long way toward determining how big a winner you become. So he's saying the better you are at losing, the better winner you're going to be in the market. Interesting. After all my years in the market, there is absolutely no doubt in my mind that one of the real keys to winning is learning how to lose. To market professionals, it's a fact of life. It's a cost of doing business. Specialists and other pros don't lose sleep if a position ends up in the loss column. They concern themselves with 2 far more important factors. 1, the net result of all their positions. As long as it is strongly positive, they are happy. And 2, where they will call it quits if a stock moves against them. So thinking about where they're going to get out before they get in. Some key bullet points here. Emotions are destructive if you don't deal with them properly. The first small loss is the best loss. If a stock doesn't come out of the gate strong on the breakout, a trader should immediately lighten up their position while protecting the remainder with a very tight stop set about 5% beneath the breakout. Stocks that turn into great trades rarely drop back below the original breakout point. So interesting, the best stocks will usually just break out and go. They all just run for it. Protect all of your positions with stops and don't ever make an exception. So Stan really stresses risk management. That's what we've been talking about as well, with where to position initial stops, where to then move stops with some of those examples. In the next slide, we're going into best long-term indicators. So Stan talks about several best long-term indicators to use in the book, and my favorite is the advanced decline line, so that's what I'm going to teach you here. So the advanced decline line is basically the difference between advancing issues and declining issues, and it can be tracked like this. So what you are looking for though is divergences, both positive, so bullish divergences, and also negative divergences. So here we have on the top chart, we have the index, which is making higher high, higher low, higher high, higher low, higher high, higher low, lower high, lower low, lower high, lower low. And the advanced decline line is matching that. Now the advanced decline line is a measure of breadth, so it's a breadth indicator to indicate a little bit more what's going on in the surface. So let's go forward. So here we have the index, okay, on the top, and then we have the advanced decline line on the bottom. What chart pattern do you see as well on here? Interesting, right? Left shoulder, head, right shoulder. Now what's interesting here is the advanced decline line has a bullish divergence from the index. As the index makes a lower low, so in here, see how from this point here to this point here, the index makes a lower low, whilst the AD line makes a higher low. So this is a positive divergence. This is a bullish divergence. The advanced decline line, which is a breadth indicator for underneath the surface, how are individual stocks doing, which make up the indexes, by the way, are putting in a higher low. So you have the advanced decline line, the AD line, putting in a higher low, whereas the index is putting in a lower low. That there is a positive divergence, a bullish divergence, telling you breadth underneath the surface is improving. You can often see that in head and shoulders bottoming type patterns. Now conversely, what chart pattern do you see? We're getting somewhere. Left shoulder, head, right shoulder. But what happens here? Well, the index makes a higher high. So this being the left shoulder, this being the head, makes a higher high. What does our AD line do? Our advanced decline line do? It makes a lower high. Interesting, right? So this is actually telling us the market is making a higher high, but breadth underneath the surface is deteriorating, okay? The stocks, the individual components, i.e. the advanced decline line, is not confirming the move of the index. So this is a negative bearish divergence. It can indicate the breadth under the surface is deteriorating. So on the prior slide, we can look for higher lows. When the index makes a lower low, but the AD line makes a higher low, it can indicate breadth underneath the surface is improving. But if we see the index making a higher high not confirmed by the AD line making a lower high, it can indicate that there is deterioration going on underneath the surface. So this here, I'll just show you this. You can see at the minute, this on MarketSmith. So the AD line is here. Okay, this is the AD line, and then this is the S&P 500. Can you see how it's pretty much moving? It's just in step here, isn't it? Okay, the market goes up and at the kind of significant highs and significant lows, the AD line is just matching it. Okay, the index makes higher highs or lower lows, and the AD line is just matching it. I'm not seeing right now a positive or negative divergence as such, really. So that there is something to be thinking about. Maybe you could say somewhat the index in here actually kind of holds the lows here, where the AD line puts in more of a lower low. So actually that could signal a little bit of strength going through. But this is something that I look at around about once a week, or if the market's trying to make a higher high, or potentially it's coming down to a previous lows, I'll pull up the AD line and have a look. But I do give a significant amount of emphasis on the individual stocks as well. How are they acting? Which groups are leading? So this one here, we are now going back to, remember what we did at the start of the presentation, where I said which chart is more bullish and which chart is more bearish, which chart is more bullish. And now hopefully you have a really good understanding of which chart is more bullish. And you've actually probably just gone, it depends. If that was your first thinking, it depends, this video has done its job. It depends. Why does it depend? Are you an investor or are you a trader? Because if you're an investor, well, it's probably going to be chart number 1. Why? Because the stock is coming out of a stage 1 base. If you're a trader, it's probably going to be chart number 2. Why? Because the stock is coming out of what looks to be here a stage 2 uptrend. So it's interesting. It's relative to whether you're a trader or an investor. So remember, Stan said investors do 80% of their buying from stage 1 base breakouts, 20% from stage 2, and traders, it's the other way around. 80% from stage 2 breakouts, 20% from stage 1 breakouts. Let's do another one. Which chart is more bearish? This is an interesting one, isn't it? Maybe I'm trying to trick you a little bit. So what chart pattern do you see over here? Head and shoulders top, right? You've got your left shoulder here, higher high for the head, and then your lower high for the right shoulder here, and it's taking out these lows. Then over here, number 2, you've basically got a stock that just cannot rally, okay, just can't get back above, and it's breaking down through the support. Both of these are actually very, very bearish. And this is where, again, I wanted to kind of trick you somewhat. It then depends on, well, where is the next logical support level? Has chart number 1 just gone from $10 to $150 and now there's significant downside to the next support level? Or chart number 2, is there potentially, if this is breaking through say $30 but there's significant support at $20, well, actually chart number 1 is going to be much better. So it's relative. So this is why it's thinking about things, pulling up the chart, thinking about it and going, well, what stage is it in? Here we're saying stage number 2, and then so stage number 2 for stage 4 for chart 2, and then over here on chart 1 we're saying this is a stage 3 top going into stage 4. But it then also depends on what is the trend of the market, what's the trend of the group as well, what are the other brother sister stocks in the group doing as well. That may all kind of feed into which stock is the best short candidate. It can also depend, as we were just discussing, where is the next significant support level, how far could the stock fall, where is the key moving average, is in this instance here, does it have the 30-week just kind of reclaiming here, so it may only just come down to the 30-week, or in this instance here is the 30-week up here somewhere and the stock is topping out like this. So it really depends. There is no real clear answer here, which is why I wanted to kind of leave that with you. So now I just want to summary of Stan's method. Here we go. Know the stage of the market. Know what the leading and lagging groups are and what stage they are in. Know the stages of leading and lagging stocks from the leading and lagging groups. A lot of leading and lagging there, isn't there? This helps with trade identification for the A+ longs and also the shorts. Longs in stage 1 and 2, shorts in stage 3 and 4. Always control risk and have clear exit rules. Create favorable reward to risk trades. Ride trends. Remember, Stan Hart was an intermediate term trend follower. Check weekly the AD lines for divergences and when the index make new highs and or lows. Have a plan and trade your plan. I hope you have really enjoyed that video. Please subscribe to the channel for more videos like this. Turn on that little bell so you'll be notified when I release videos like this. It really helps me out if you press the like button. So please press the like button. Any questions that you have, any comments, please do leave them down below and I will get back to you as soon as I can. As I said, thank you very much for watching and I will see you in a future video.